Drake trades in his old car, rolls what he still owes into a new loan, and drives off feeling like he upgraded. What he doesn't realize, he just bought a car he can't actually afford yet, using debt from a car he already couldn't afford. This happens to nearly a third of car buyers in America right now, and almost none of them notice it happening. Meanwhile, Daniel is still driving the same car he bought years ago, and it's quietly the smarter financial position of the two, even though it looks like the less exciting one. This entire video is about one specific number that determines which of those two situations someone ends up in, and it has nothing to do with income. It's the length of the loan compared to how long the car is actually worth what's still owed on it. Quick one before we get into this. If breaking down the debt traps nobody explains is useful, hit subscribe, new video every week. Negative equity means you owe more on a car loan than the car is currently worth. Cars lose value the moment you drive them off the lot. And if your loan is long enough or your down payment small enough, the loan balance can fall slower than the car's value does. According to Edmunds' own research, nearly 30% of all trade-ins toward new vehicle purchases carried negative equity in the second quarter of 2026, down slightly from 30.9% in the first quarter, which was the highest share recorded since early 2021. The average amount owed on these underwater trade-ins was $6,884 in the second quarter of 2026. That's not a rounding error. That's thousands of dollars of debt that doesn't disappear when you trade the car in. It just moves. Here's the part that makes this a trap, instead of just bad luck. Dealerships can roll that leftover balance directly into the new loan. Your old car is gone, but the debt from it is still there, now hidden inside a bigger loan for a different car. Edmunds found that 90.2% of new loans involving a trade-in with negative equity carried terms of at least 72 months in the first quarter of 2026, and 43% stretched all the way to 84 months. 7 years of payments on a car that will likely be fully depreciated long before the loan is paid off. Some vehicle categories are worse than others here. One widely reported example found Toyota Tundra owners rolling an average of nearly $9,000 in negative equity into their next loan. The specific truck or car matters less than the pattern, a longer loan to make a bigger. Debt-inflated number look affordable on a monthly basis. The mechanism behind why trucks and larger vehicles show up disproportionately here is straightforward. Bigger, pricier vehicles depreciate by a larger dollar amount in the first year or two, even if the percentage looks similar to a smaller car. A loan size to a $50,000 plus truck simply has more ground to make up before the balance catches up with a value that already dropped fast. None of this makes any specific vehicle a bad choice. It just means the same loan term math matters even more as the price tag climbs. The average term on all new vehicle loans in the first quarter of 2026 was 73 months, just under 6 years, and that's across every buyer, not only the ones with negative equity. Stretching a loan out lowers the monthly payment, which is exactly what a buyer focused on "can I afford this per month" wants to see. But a lower monthly payment on a longer loan usually means paying more in total interest over the life of the loan, and it means staying underwater for longer, since the balance falls even more slowly. This is the mechanism the dealership finance office is optimizing for. Not what's actually the best deal for you, but what monthly number gets you to sign today. It doesn't help that the starting price keeps climbing either. The average new vehicle now transacts somewhere between $49,000 and $52,000. And the average new car loan payment sits around $770 a month. Rate matters too. As of mid-2026, the average new car loan rate is running somewhere between 6.4% and 7%, but that average hides a massive range. A borrower with top-tier super prime credit was recently paying around 4.7%, while a borrower with deep subprime credit was paying over 16% for the same car. A longer term is often the only lever left to make a big price, a real interest rate, and a rolled-over old balance add up to a monthly payment that looks survivable. Daniel's version of this looks almost boring by comparison. He paid off his car years ago and kept making a payment to himself, the same amount his old loan payment used to be, into a separate savings or investment account instead of upgrading to a new loan. Over several years, that phantom payment adds up to a real cash reserve. one large enough to pay for the next car outright. Or make a large enough down payment that a new loan never needs to stretch past 60 months. Nobody is impressed by an old car in a parking lot. But the math underneath it is the entire difference between staying in car debt indefinitely and eventually having no car payment at all. Run the numbers concretely. A $500 monthly phantom payment kept up for 5 years, even sitting in a plain account earning close to nothing, adds up to $30,000, enough to buy a solid car outright with room to spare, or make a down payment large enough that the next loan barely needs financing at all. Put that same $500 in a high-yield account instead, and the total climbs even higher. Either way, the number that used to disappear into a lender's pocket every month is now building something that belongs to Daniel. This isn't an argument to never trade in a car. If a car needs a major repair that costs more than it's worth, or if a growing family genuinely needs more space, trading in makes sense. The trap isn't trading in. It's trading in while underwater, rolling the difference forward, and doing it again in 3 years without ever checking the negative equity number first. The one number worth checking before any trade in: your loan's actual payoff amount versus the car's current trade in value from a source like Kelley Blue Book or Edmunds. If the payoff is higher, you're underwater, and rolling that gap into a new loan should be a deliberate decision, not a surprise the finance office mentions halfway through paperwork. If you're already underwater right now, the situation isn't unusual, and it isn't unfixable. Being upside down doesn't directly damage your credit. The loan still gets paid the same way either way. The most reliable fix is simply keeping the car and making extra payments toward principal, which closes the gap faster than the minimum schedule alone. Refinancing can help too, but only if it genuinely lowers your rate or shortens your term. Refinancing into another long, low-payment loan just resets the same trap. If you do trade in while still underwater, know the real cost first. Rolling roughly $7,000 of negative equity into a new loan typically adds somewhere around $110 to $150 to the new monthly payment, without changing anything about the new car itself. That's the actual price of not waiting. There's one more risk specific to negative equity that most people never think about until it happens. If the car is totaled in an accident, standard auto insurance only pays out the car's current market value, not what's left on the loan. If you owe more than the car is worth, you can be stuck paying off a loan for a car you no longer have. Gap insurance exists specifically to cover that difference, and with the average gap claim now around $4,987. It's not a small gap to be caught without coverage for. Where you buy it matters a lot. Dealerships typically bundle gap insurance into the loan itself for a lump sum up to around $700, which then accrues interest along with the rest of the loan. The same coverage bought directly from a car insurance company often runs as little as $20 to $40 a year. If you're financing a car with little or no down payment, gap coverage is worth having, just not at the dealership's price. Extending a loan term to lower the monthly number is one of the most common ways a car purchase quietly costs more than it needed to. A longer term at a similar rate means more total interest paid over the life of the loan. Even though the sticker price of the car never changed. It's the same trick lower monthly payments always play. It feels more affordable today, and it's actually more expensive over time. The fix isn't complicated. It's shopping for the shortest loan term that still fits a reasonable monthly budget, and treating a 72 or 84-month term as a warning sign that the car itself may be more than the budget can actually support, not a normal financing option. This isn't a hypothetical risk either. The share of auto loans seriously delinquent, 90 or more days past due, was around 5.2% heading into 2026, just barely below the peak seen during the 2008 recession. For borrowers with subprime credit specifically, the share at least 60 days behind reached its highest level on record in early 2026. Vehicle repossessions have been climbing for the same underlying reason this whole video is about. Loans originated with higher prices, higher rates, longer terms, and thinner equity are simply harder to keep current on as they age. None of this means a long loan automatically leads to repossession. It means the same conditions that create negative equity, stretched terms, thin down payments. Rising prices are the exact conditions showing up in the delinquency data. It's the same problem showing up in two different numbers. Concretely, Figure out what a car payment would be on a vehicle you're considering on a 60-month loan at a realistic rate for your credit. If you're not ready to buy yet, start moving that same amount into a separate savings account every month. By the time you actually need a car, you'll either have enough saved to pay a large chunk in cash, or you'll have built the discipline to know exactly what you can actually sustain. And either outcome puts you in a stronger position than rolling debt forward ever will. This week's actual step: pull up your own loan documents or a car you're considering and check the term length. Anything past 60 months is worth a second look before signing anything. If you're already in a long-term loan, that's not a reason to panic. It's a reason to check your own payoff number and start closing the gap on purpose instead of by accident. This applies just as much to a first car loan as it does to someone rolling over their fourth one. The earlier the habit of matching loan length to how long you'll actually keep the car forms, the less negative equity ever has a chance to build up in the first place, and the more likely a first car loan is the last one that ever needs financing help from a prior trade-in. It's worth a brief mention of leasing here, since it sidesteps the negative equity problem entirely in a different way. The average new car lease payment is around $619 a month versus $770 for the average loan payment, because a lease only charges you for the car's expected depreciation, not its full price. There's no negative equity to roll forward because you never owned the difference in the first place. The trade-off is straightforward. At the end of a loan, you own a car outright and can stop paying entirely. At the end of a lease, you own nothing and start the payment over again. Leasing avoids this specific trap, but it replaces it with a payment that, for most people, never actually ends. One more data point worth knowing: the average used car loan payment is around $531 a month, noticeably lower than either a new loan or a lease. Buying used doesn't eliminate negative equity risk, but a lower purchase price generally means a smaller gap to fall into in the first place, all else equal. Nearly 30% of trade-ins carry negative equity, averaging close to $7,000 rolled forward into the next loan. Longer loan terms, 72 to 84 months, make that debt easier to hide and slower to pay off, and the same conditions show up as record-high subprime delinquency. If you're already underwater, extra principal payments and a genuine rate or term improvement on a refinance beat rolling the gap forward. Gap insurance, bought outside the dealership, is cheap protection against the one risk that can make this worse overnight. And whether it's a 60-month loan, a lease, or a paid-off car with a phantom payment going into savings instead, the fix isn't never trading in a car. It's checking your actual payoff amount before you do, and treating a shorter loan term as the real goal, not just a lower monthly number. This video is for educational purposes only and is not personalized financial advice. If this changed how you'll look at your next car loan, subscribe, new video every week. Before your next trade-in, pull the actual payoff quote. It takes one phone call. Next up, why everything actually changes the moment you hit $100,000.